Good evening and welcome to this week's edition of WealthQuest. I'm Samantha Loring. Our topic of the week focuses on impact investing. Investing is about long-term viable returns. Now, academic literature has documented the process that needed to achieve this through what can be called sustainable strategies. New questions are being asked. How does one promote environmental, social and governance criteria at the same time? Now, this, of course, particularly important for South Africa and more broadly Sub-Saharan Africa with great social challenges. Socially responsible investing avoids investment in assets which can be perceived as harmful. So how can investment ideas be screened for their merit? And returns incorporate the broader definition of a positive return to society at large. So tonight we're looking at impact investing, and joining us from our Cape Town Bureau to give analysis on what impact investing means in South Africa, Mark van Wyk, fund manager at Mergence Investment Managers, and the man who recently swapped his environmentally friendly Toyota car for a Mercedes, Kobie Lekranji, strategist at Clucas Gray Investment Managers. Welcome to you both. Mark, I'll throw straight to you and get Kobie off the hook with that one. Tell us about why impact investing is so important in a South African context.
Thank you very much. I think from a South African context, South Africa has got an efficient market economy where with a lot of savings pool and also the opportunity to actually mobilize some of that savings to address some of the social ills our country is currently facing. Our government has highlighted to the fact that the social ills is somewhat more than what they can actually muster themselves and actually addressing. And there's been a call on the private sector and the society in general to come and address some of these issues. Mm-hmm. We believe that from that business in the private sector can address some of these issues and also give return to investors into what we call beneficial business models and basically have the best of both worlds where we get a return and address some of the social ills at the same time.
So we're looking for win-win here. Talk to us about some of the issues we're looking at here in South Africa.
Yeah, I mean, I think firstly, most of the issues that you're seeing in South Africa has been well documented. I mean, you just have to open up the newspaper in order to understand some of the issues that South Africa is going through. But quite frankly, it's something that emerging markets generally are going through. And quite interesting, since 2008, we're actually seeing some OECD countries going through this as well. But maybe just to bring it home quickly, just have a look at the following chart over here. This is SA social attitudes. And we're talking here, this is from the HSRC. This is a social attitude survey, and they asked the question, what do you think impacts South Africa? And well, quite frankly, unemployment. A lot of the people are saying unemployment is obviously rife in the country. HIV continues to plague us as a society, and you could see some of the other issues that are plaguing South Africa as a society. And then I suppose the root cause of a lot of what we're going through at the moment is obviously education and the fact that so few people actually finish their tertiary education in South Africa. And here you can see if 100% of kids today actually enroll in grade 1, how many of them end up at the end of the day graduating? Well, only 3%, whereas the OECD average is about 40%. So we've got a ton of stuff actually playing itself out in South Africa. And there's a continuous move by Treasury saying, listen, how do we get investors more aligned to these issues? Mm-hmm. And how do we get investment money, which quite frankly is mostly pension fund money, how do we get that aligned to this? So Mark, I mean, just throwing this back to you, I mean, your high impact fund takes the root cause as far as these issues are concerned. Tell us a little bit about that.
Our fund basically is complementary to the investors' portfolio into fixed income asset allocation. And what the proposition is that with the well-diversified portfolio of what we call impact investments, the investor can make the impact and get return and reduce the risk of its fixed income portfolio. The proposition is, from the fund perspective, is to have as a diversified fund looking at the different challenges and investing in business models that address those challenges head on. And even looking at business models is where the addressing of the challenge is its core mission and focus of the business. But it's a business. It's not a non-profit organization or a corporate social responsibility investment that is being made. It's an investment being made in a business that where the management can generate some revenue, by addressing the social issues and giving a return and the capital back to the investors again.
This made up of 50% listed debt and 50% unlisted debt. So we've got a slide now that shows you the portfolio holdings as they stand of Mergence High Impact Debt Fund. As you can see there, CPV Power Plant. You've also got SA Taxi Finance Solutions, South African National Roads Agency, Sanral, of course. When you're talking about Sanral, are you concerned around the model there that is being used at e-tolls? Is that a short-term issue for you in the broader context of what Sanral is doing, Mark?
It is an issue to a certain extent. However, we believe that the business model of Sanral is quite robust. We believe that our capital invested into the entity, the state-owned entity, is safe and we will get our returns. We believe in the medium to short-term outlook. Resolution will be made on the business model of Sanral going forward. Yet we do believe that the business is critical in the infrastructure rollout of the country, and especially with regard to transportation. And it still offers good real rate of returns for us as investors, where we benchmark against real rate of returns.
Mm-hmm.
Maybe, Mark, just a question from my perspective. I mean, if we go back in time, let's go back a decade in South Africa. I mean, a big buzzword in this country was social responsible investing, and it was actually that for a very long period of time. We're talking about impact investing now, which is slightly different to social responsible investing. Is it different? And if so, how?
Yeah, so what we have in social responsibility investments, we've either got positive or negative screening, where we're screening out businesses that is harmful to society in terms either the product it provides or the process whereby it goes providing that product or service. What we're looking at in impact investments is we're looking at business models that's designed specifically to address an issue, whether it's housing, or whether it's education, or whether it's providing financing to small and medium enterprises. And most of these businesses are medium to large businesses and not necessarily listed businesses. So it makes it very difficult for institutional pension funds to access on the listed bond market or the JSE, the equity or the debt issuances of these businesses.
Mm-hmm.
What we're doing on our side is we're looking below, we're going a little bit lower into the investment cycle and saying, well, there's a niche of unlisted medium-sized businesses. Some of them are actually large enough to potentially be listed but remain unlisted, who needs working capital to continue doing what it's doing and indirectly address the issues that we face as a country. So we've had a move away from social responsibility investment, which is positive negative screening on the listed equity market, and we're saying, well, we've got unlisted businesses that gives a bit more of a direct impact for every rand invested in them in addressing some of the issues.
And of course, you can see that you, of course, appeal to the large investors, institutional investors, with that 50 million rand minimum investment there. Let's just look at the returns that we've seen for the fund, and we've got that graph up on the screen. Just looking at the 1 month period, sitting negative 1.4%. The benchmark there is sitting at CPI plus 3%. Year to date, 1.6%, and that you can see the benchmark there. If you look at that from a longer term perspective, of course, the return slightly more aligned with what we're seeing when it comes to that benchmark. Mark, talk us through the choice of the benchmark. Talk us through the returns we're seeing. We're expecting to see coming through from this impact debt fund, and also what type of dialogue you're having with investors around what they have given you as a mandate.
In terms of the return benchmark we've chosen, is we believe that the inclusion of that benchmark into the fixed income portfolio of an investor is a compelling proposition. In terms of the type of assets that goes into that benchmark, it's a conservative benchmark, and therefore the underlying assets also need to be conservative. So we're very cognizant of reducing the credit risk exposure to the investors in terms of potential capital loss, and therefore we try to diversify the portfolio as much as we can, and also go for higher credit quality assets with what we call the commensurate levels of security and credit enhancement in the portfolio. With regard to the return, the outlook going forward on the portfolio, given the fact that the fund's underlying assets are mainly what we call prime or JIBAR-linked instruments, and given the negative or close to negative real interest rate environments that we're currently at, where inflation is relatively still high, yet the interest rate is benign and depressed. Reverting back to a normal scenario, which we hope to see within the next 2 to 3 years, we believe that the fund will outperform its CPI plus 3 benchmark with its current portfolio of assets quite commensurately. And we're quite positive that it will give a good result in terms of performance and risk diversification for its investors.
Let's maybe just look at the impact analysis for the specific fund. If you have a look at the graph up on your screen right now, this is the asset allocation graph. And you could have a look there. You see infrastructure, about 38% of the fund. That's the debt instruments representing infrastructure in South Africa. Housing at about 23%. Everybody will agree that that's a major issue. And then you could look at municipalities at 6% and education at 12%. Mark, tell me, tell us quickly here,